Good afternoon, and thank you very much for joining the latest BetaShares webinar. We'll just be starting in just a few moments, just waiting on a few more people to join, and then we'll get started. Thank you. Good afternoon, and thank you for joining the latest BetaShares ETF 101 webinar. My name is Sarah Hare, and I'll be hosting today. Our webinar today is Investing for Different Life Stages, and we're joined by Roger Cohen and Alistair. Before we get started today, I'd just like to remind you that anything discussed today is general in nature. We're not taking into account any personal circumstances, and as always, before you make any investment decision, you should do your research and consult a finance professional. All attendees will receive a recording and the presentation slides today following the webinar. If at any time throughout the webinar you have any questions, on the right-hand side or on your screen, you'll see a widget. Ask your questions throughout, and we'll be taking them at the end, and we'll try and get to as many as we can. So if anything pops up during the session, please do write us a note, and we'll answer that. So just before I do introduce our guests today, I just wanted to start with a quick poll, and it's quite fitting, but we just want to know where you think you are on your investing journey. So what stage do you think you're in? Do you think you're starting, you're accumulating, building wealth, you're accumulating to retirement, or you are actually in retirement? So just a quick poll. Sometimes what people think they are isn't necessarily where they are, but it's always interesting to know. So I'll just give you a few more seconds. It's looking pretty interesting. Okay. All right. So I'll just close it there. And what I'll do is share the results so everyone can see what sort of audience we have. So, you know, slightly skewed towards retirement. But then, you know, the accumulators and accumulating into retirement is even there, and a few starting out on the journey. So hopefully lots of information for each stage. So without further ado, please let me introduce our main host for today, our main speaker for today, Roger Cohen. Roger is a senior investment specialist here at BetaShares. Formerly with Deutsche Bank and Macquarie Bank. He's an absolute wealth of knowledge. In his spare time, he's a lecturer in mechanical and aeronautical engineering, which we absolutely love. So Roger will be speaking today. Joining Roger is Alistair. He is a portfolio analytics and in our advisor services team. Alistair's from London and was working at one of the biggest ETF providers in Europe, Alistair Asset Management, before joining BetaShares. So, Roger, welcome.
Thanks very much, Sarah, and hello to the audience. So, before I start going through the stages, I really want to say that these stages are fairly arbitrary, and there is a continuum. So obviously you're going to start the journey, you're going to go through the journey, and you're going to head towards retirement. And exactly where you are is partly age-driven, but it's also very much your own circumstance, your own views and attitudes to what you're doing with investing and saving, and where you put yourself on the spectrum. And even, you know, in some of the hard definitions, so you're retired because you've turned 65, you've ceased working, but you've got a long way ahead of you, and you've got to weather market cycles. You've got a lot to see before, you know, on the journey. So let me begin, and we'll talk about the journey and starting the journey and the first investments when you begin the journey. And I'll begin with some of the cons. So generally, you're young, and investing, especially investing for retirement, is something that's got a low time allocation and very low priority. You're only beginning your earnings journey, so your balances and your amount of money that you can invest is probably low. Probably don't have access to much information or experience. You're investing small amounts. You've got multiple sources of income, so you may have things paid into different super funds. And of course, you need to prioritize your own lifestyle. What do you spend today versus what you put away for the future? So those are some of the cons or the things working against investing. But of course, there are some pros, and those pros are very, very important and work in your favor. The biggest one being a long time frame. Second is you have a low sensitivity to volatility. The market is going to go up and down. Investments are going to increase and decrease in value over the time that you hold them. But in general, if they are good investments, by the time you actually want to realize them, they will have gone up. And the big one is the benefit of compounding. Putting money to work as an investment and reinvesting as you go along is an amazing thing. So what should new starters be looking at? The first thing I would say is aim for as much exposure as possible to the market. Look at low cost, good quality investments with long-term high return expectations. And diversification is really your best form of risk management. This is a theme that we keep coming back to. So you want to invest in broad-based products that track indices and things like that are diverse. Another great thing when you're starting to invest is to invest regularly, because when you invest regularly, you're not so worried about the short-term volatility. You're buying on the dips and you're buying on the rises, and the effects of volatility will be diminished by that. I'm going to hand to Alistair, and I'll ask you a question, which is how would a new starter begin investing?
Yes, thanks, Roger. As a starting point, I'd say, one of the key things is probably to set up an online brokerage account outside of your superannuation. This is easy to do, often linked with your traditional bank account. ETFs, once this is up and running, ETFs are an extremely easy way to gain access to the market through this. Within your super fund, as Roger mentioned, investors may have been working multiple jobs, they may have different super accounts. It's worth consolidating these as soon as possible. And within that, looking to get themselves into the highest growth bracket as possible with that long time horizon. When you're young starting out, there are many benefits to using index exposures, which are low cost and you can set and forget in some aspects. Keeping it simple with a small number of core exposures which offer you diversification, and adding to those as often as possible with as much as you can is a great way to build wealth over the long run. Say at this stage in life, focusing on growth rather than needing the income supplemented through dividends is probably a beneficial way to go. You may want to consider with all of your investments a dividend reinvestment program. This is available on all of our ETFs and can be done automatically. I'll touch on a few examples of funds which may fit in the bracket of what we've discussed. Again, these are just examples. There are a plethora out there. First of which is our Australia 200 ETF. This gives simple access to the broad Australian market, the 200 largest stocks on the ASX, in one simple trade. It's actually the cheapest of its kind on the market, with a management fee of 0.07 basis points per annum. You can buy and sell this very easily on the ASX through the ticker A200. If we look internationally, on a similar vein, the BetaShares Nasdaq 100 ETF gives investors exposure to some of the largest names in the world. You're looking at things like Google, Apple, Amazon, Microsoft, Facebook, without having to open an international trading account. This exposure actually complements the Australian market very nicely because of your overweight to technology and consumer discretionary. Doesn't have any of the financials or the resources stocks that you inherently get through the Australian market. So adds a layer of diversification through your portfolio. This can be accessed through the ticker NDQ. And then I thought it was worth touching on, we have two responsible investment funds, and if you are this way inclined, these can be a great addition or substitute for funds such as the ones as I've mentioned previously. These funds have screens for sustainability leaders, but also negative screens to remove stocks that are dealing in businesses which aren't deemed in line with responsible investment, such as fossil fuels, junk food, armaments, tobacco. On the international side, we have ETHI. And on the Australian market, well, for Australian equities, we have FAIR. So just moving into the next stage, Roger, what are some of the ideas that investors can start looking at during the accumulation phase?
Well, I guess once you've started and you've got a few of the core exposures, the types of things that you just mentioned, Alistair, you're now sort of set on your life journey. You're probably earning more. You will definitely have more expenses. You've got children. You may be saving for a property or holidays or other lump sums. You're probably contributing to super through your employment and perhaps outside employment. And you may also be investing outside your super. So you may have another bucket or another place where you're investing. And of course, you should ensure that you've got enough insurance, both medical and other, to protect yourself against something that you're hoping doesn't happen, of course. So during the accumulation phase, you need to, of course, make provision for your running expenses, your day-to-day, and your short-term lump sums that you'll need for school fees or for holidays or other things. But of course, you are going to be accumulating for retirement, mostly through your super, but you may also be looking at investments outside super. So if we look at that accumulation, what are you really doing? You still have a very long journey ahead of you, so you want to invest regularly for the long term. Same theme as before, you want to diversify. You don't want all your exposures to one asset or asset class. And you still want to target things that have growth and potential high returns. And of course, don't ignore the international assets. Your day-to-day life is full of exposures to international, your technology, your overseas holidays or aspirations for overseas holidays, foreign goods. So you may as well benefit from the returns that those markets can generate.
I suppose just stepping in with a question there, Rog. Obviously, when you're in the starting out phase, you're young, you've got a very long time horizon, probably don't have the liabilities and expenditures you may have in later life. Volatility, probably not too much of a concern. As you move into that accumulation phase, and you may start looking at buying a house, having kids, those expenditures, does volatility become a primary concern within portfolios?
It's a good question, and the answer is interesting because you're still investing for retirement, you still have a very long time horizon, you're still going to go through market cycles, so you are going to see volatility. And whilst volatile investments are perceived as being risky, they're also often associated with high returns. And again, if your time horizon is long, volatility is not necessarily a bad thing because it enables you to buy the dips as well as the peaks. So in your retirement and your long-term savings, volatility is not something that you should be overly focused on. It's more the quality of the investments and the expected returns. However, if you are saving for short-term goals, so you need something for a holiday or something like that, that's a completely different question. Diversification is really one of the best forms of risk management, and it's not a form of risk management that you explicitly pay for. But just remember, not all investments will deliver at the same time, and they won't all deliver as expected. So by making sure that you spread your exposures out, you will not be unduly affected if one or two or a small number of your investments perform differently at any one time. Growth and high returns, you're still accumulating, so you're looking for things that have got growth and high returns. Income is not important at the moment. You really want to concentrate on total return, and you want to reinvest any income back through dividend reinvestment programs, distribution reinvestment programs, and maintain that focus on growth products. I mentioned before international assets. I don't really need to say much more about that, but it is very important to have exposures, and you can benefit from the high returns that you get from international exposures. What are some of the products that would suit you in an accumulation phase and that you would add to your portfolio?
Yep, absolutely. I mean, first and foremost, I'd say investors should always be adding to those core parts of the portfolio. Some of the exposures mentioned as examples previously. With a bit more money and experience under your belt, you can start diversifying further, adding to your international exposure, maybe involving some thematic investing. investors may want to consider using fixed income to diversify away from their equities slightly as well, just trying to get as many return sources as possible. I'll give a quick example to just a select few. I'd highly recommend popping onto the website, looking at the full range of funds. We've got 51 out there, different ones can match your individual investment objectives. So these are just a couple of examples. Firstly, in terms of broad international equities, the BetaShares Global Quality Leaders ETF gives access to a diversified basket of quality companies. These are profitable companies with high financial health. The index itself actually applies many of the screens that some active managers apply themselves, but you can get a diversified basket for 0.35% per annum. You can access this fund on the ASX using the ticker QLTY. Looking at thematic investing, our global cybersecurity fund HACK gives exposure to a thematic which, if you believe in the growth of internet and cloud-based computing and that technological advancement, the growth in cybersecurity spending could be spurred even further by this. So a great thematic if you believe in that. On a similar note, the BetaShares Global Robotics and Artificial Intelligence, if you believe in the shift towards robotics and AI, a great way to play this thematic is through our fund RBTZ. And Asia provides access to the Asian technology thematic, which may benefit from significant growth in the middle class or internet usage in countries such as China. And just as I mentioned, if you're looking to increase exposure to fixed income, you can use something such as CRED, often seen as the defensive part of the portfolio, but investment-grade corporate bonds can actually provide a pickup over government bonds themselves while still offering diversification from your equities.
Thanks, Alistair. I really like those themes, and I'm sure over time more themes and thematics are going to come out. And the only thing I would say there is look for themes that are going to be around, not fads, when you choose your thematic exposures.
Absolutely.
Before we go on, I have a question for you, which is really the difference between accumulating for your super and your retirement and also your needs outside super, and what are some of the things you can do?
Absolutely. Well, the needs are pretty different. If you're investing or accumulating and adding to your super, your investment time horizon is still extremely long. You know, you may be in your 30s, you're still building up a super fund going into your 60s, 70s, hopefully 80s and beyond. So you're looking probably to grow that pile of money as best as possible. Outside of super, and you touched on it earlier, you may have short-term liabilities involved, large expenditures, particularly if you're looking to accumulate into retirement. People take large holidays at that point. Having liquid investments within your portfolio that you can access, such as ETFs, which have great liquidity profile, can be a serious consideration. So the two can be quite different. It very much varies on when you want access to your capital.
Thanks. So I'm going to focus on the accumulating into retirement, and now you've had a reasonable journey, you've got some experience, you've got a diversified portfolio of assets. And I would say as you're accumulating into retirement, and retirement is becoming something tangible rather than ethereal and way out in the future, you still want to focus on accumulation. You still want to focus on growth, especially inside your superannuation. And it's really time to start thinking about what you will need and do in retirement rather than to act initially. But you should look at the effect of market cycles and have in the back of your mind that we do see these periodic cycles where we get big sell-offs in the market, and that's obviously detrimental to your investments, but it's of course a good time to be adding to those investments and buying into the market. It's now time to have a look at whether you're happy with your superannuation, both with the mix of investments you've got and the way they're being managed. Is there a reason to set up an SMSF, or are you happy on a platform or with a third-party provider? And are there particular investments that you should be looking at that really match up with your own philosophy and your own exposures and your own preferences? And you can start thinking about the transition into assets with some capital stability, but realize that retirement is not an instant point. It's really a continuation of the journey, and a new retiree is still going to need to put some of their capital into growth. as well as look after their own shorter-term needs and liquidity. So income is not a focus, but it will become important. Maintaining your insurance and everything that allows you to maintain your lifestyle is important. And it's probably worth thinking about, and most of us don't, is to start preparing a retirement plan ahead of time rather than waiting for it to come to you. So what is this retirement plan? And it's really looking at what is your superannuation stream going to look like, and does it match your own aspirations? And there are many tools out there, such as the ASIC Money Smart Planner, or of course your own financial planner who can help with this. And what you should do is work out what is the rough budget. So what sort of income are you going to need for your day-to-day living, and what will you be needing for lump sums for holidays and renovations and other things? Do you have enough super? Do you have opportunities to top up your super as you're approaching that retirement point? And also start thinking about the transition. So do you have enough in your super for the short-term daily liquidity and the lump sums that you'll need in the short term? And what happens if there is a large drawdown, if there is a market crash, and how is it going to affect you? You should probably set up a time frame to start this transition process and to make sure that your portfolio is in the right shape. And it's not, again, something that occurs in one step. It's really very much a phased implementation. You can do it slowly. You can start dipping your toe into the water and gradually do that transition. And of course, succession and estate planning are something that you should also be looking at. And again, there's a number of products that you can add to your portfolio and also start using in that transition. So I'll ask Alistair to help with that.
Yep, so you covered really there, Roger. I mean, at this stage of life, investors may wish to start including some exposures which can offer more stability, or at least start thinking about their future income stream. So consider adding some of the sort of exposures to their portfolio. Again, liquidity can be a significant consideration. If you do not require that income at this point in time, again, that dividend reinvestment program can always be used, even if you do start adding some higher yielding exposures there, just to set yourself for the future. Again, I'll run through a few examples of these sorts of exposures that may complement the ones that we've already been speaking about. And very simply is our cash ETF AAA. This fund currently has a net interest rate of fees of around 2%. That pays that interest monthly. We have a selection of fixed income funds which pay regular distributions, and historically some have offered very high stability when compared particularly with equities. Coupon can offer returns above cash as you're actually holding floating rate bonds, whose rates move up and down as interest rates change. Hybrids are another one. They're an alternative to things such as bank stocks, potentially historically offered lower volatility with comparable yields and franking. Hybrids is a great way to outsource the management of hybrids through an actively managed fund. And then again, looking internationally, investors accumulating into retirement may wish to start adding some more income-paying exposures, particularly in the international part of the portfolio. INCM actually offers, or its index actually offers, as of the end of March, a yield of around 4.7%, and that's net of withholding tax. So it can complement the yields in the Australian market quite well there.
So those are some interesting products, but I have a question for you. Why did you talk about AAA, the cash fund, when we're talking about still accumulating and trying to still target growth?
Yep, absolutely. I mean, yes, growth can still be a serious priority there, but the one thing you may have, and it comes back down to that discussion on liquidity, cash is obviously the most liquid part of any portfolio, even within an ETF. You can deploy your cash on any of those large expenditures which you might need. If you've built up a decent war chest of cash within the portfolio, you're unlikely to have to sell down the other equity portions within it. So it's just a liquidity buffer for you to put to use if you need to, really.
Right, so it's really the vehicle to start putting that holiday I'm going to take when I retire into another fund that's going to be part of my accumulation strategy.
Absolutely, it's sort of as an aside to that accumulation part of the portfolio.
All right, thank you. So We now move into retirement, and this is, I suppose, where we've been doing a lot of work to get to this stage. And retirement, again, it's not a step function. It's not something that's instant. You may cease working or transition out of full-time employment. And the biggest change is now that you're going to begin drawing down from your super rather than accumulating into super. So your fund does need to be structurally ready for those drawdowns. But retirement is a process. It's not a single point, and your portfolio should transition at that process. So at 65, you've still got market cycles, you've still got a long time, and you probably do need some growth in your portfolio as well as the near-term liquidity and the income that you're going to have to take out of it. You may be qualified for a past pension based on a means test on both income and assets, and that's something that, again, planners and tools can help you to manage. And of course, you will have to manage your portfolio as your needs change, because now you are not accumulating anymore, you're not adding money to your portfolio, you're drawing it down. So it will require restructuring. You may want to do things like stop the dividend reinvestment plans now, because that dividend income is something you can use on a day-to-day basis. And of course, make sure that your insurance, your medical cover and everything is up to date. So some of the products that you can look at in a retirement portfolio, Alistair?
Yeah, so as you mentioned, I mean, up until now, it's really been focused on growing that wealth as much as you can. You move into retirement, and as you move through retirement, you start considering drawing down on that super, whether it's through reshuffling the portfolio or whether it's increasing dividend-paying allocations. So the need for income can be far more apparent at this stage in life. The other consideration is, at this stage, you probably have less time to recover from major market corrections, so focus more on the capital stable part of the investment, and adjusting your portfolio that way is a consideration that all investors should be looking at. As always, I mean, I'm going to give a few examples, but it's up to individuals how they want to manage their portfolio. These are just tools that may help you achieve your goals. We always recommend you speak to a financial advisor who can help you with some of these decisions. Just the first product I was going to have a look at, I mean, the Legg Mason Equity Income Fund, it's actually an actively managed ETF looking to provide sustainable and growing dividends from equity that grow above the rate of inflation. Similarly, in strategy, the BetaShares Legg Mason Real Income Fund is a very similar strategy, however, looks to get that income from property, utilities and industrial, so a different sector of the market. And finally, finishing off with international, the S&P 500 Equity Yield Maximizer Fund, or UMAX, enables investors to maintain US equity exposure but increase their yield in that part of the portfolio by utilising an option strategy. These are just a few examples of funds within the range that can serve different objectives and may fit within different stages of life and be complementing one another and added to all the time. Again, I recommend you check out the full range on our website. Make sure you read the PDF before investing in any of these funds as well. Over to you, Roger. I mean, as a quick
Thanks very much, Alistair. So really, I'll just summarise, and I guess as I said, the journey is a continuous journey. So you start out, you're going to try to accumulate as aggressively as possible, as soon as possible, with regular investments. You want to increase your super balances, and again, do that as much as possible, as early as possible. And while you're accumulating, you're investing for total return. You're not focused on income, and any income you receive, you should be reinvesting back into that growth. As you go towards retirement, you would continue with your accumulation strategy, but you begin to prepare the retirement plan and prepare the strategy for transitioning into retirement. And of course, in retirement, you actually do need to get your portfolio set up so that you can draw down the income that you'll need for your living expenses. You also need to work out, can your portfolio weather a market correction, and do you want to change the asset mix to make it more robust for that? And of course, enjoy the benefits of the earlier phases and all the hard work you've done along the way.
So just some things to consider. We've obviously talked about a lot of things. As with any investment, there's always investment risk. Markets and investment value can go up as well as down. there's market risk with equities, currency risk also with your international investments, and instrument complexity with bank sector concentration risk with your hybrid products, and in interest rate and credit risk with bonds and cash. Obviously, nothing is guaranteed, nothing is certain. This webinar has been information, general information only, and as I said at the start, before making any investment decision, please speak to a financial professional, do your research before you do that. So I'm happy to say that we've got quite a few questions, and quite a few on a similar theme. So look, I'll just throw it out there, and you can decide which one of you or both might like to comment. Just on changes or any potential changes to franking credit policy and how that's actually going to impact self-funded retirees if they are actually, the policy is implemented. Do you want to?
I'm sure we both have something to say on that. So the first thing is, obviously we do need to wait for the election to see exactly what happens. But what I would say is that, you know, the change at the moment is you get the benefit of franking credits, and any excess you get a check from the ATO. That check is not going to come back to you. So you need to make sure that if you've got franking credits, you use them to offset income. So that may require adding, you know, assets to your portfolio that are generating non-franked income. So international assets are good for that. Fixed income assets, property assets, and things like that. Alistair, you probably have some views on this.
Yes, absolutely. I mean, I concur completely, really. I mean, some of the higher yielding international exposures, if you're using them to supplement other international exposures which weren't paying the yield, that can offset some of the excess franking that would have been lost. There are many fixed income exposures out there which can further enhance income. And yes, exactly the same, the property, those property exposures tend not to have high levels of franking, so they can offer a significant alternative as well.
Yeah. Just one comment, I guess. This year you're still in the old regime, so franking credits are a benefit, and a lot of companies are paying out additional franking credits before the end of this financial year. And I'm sure, as you know, if the regime changes, there will be a lot more information and a lot more and time to consider what to do as that change occurs.
Another question is, how would you manage volatility if you don't have the funds to continually buy in the lows and highs?
That's a very real issue that we all have to deal with. And I suppose the one mitigating factor with volatility is time. So if your time horizon is long, that effect of volatility is not going to hurt you. If you've made an initial investment and you just hold on to it for a long time, if it's a good quality investment, it will weather the ups and downs. The problem is really what happens if you have one shot and you're at retirement or near retirement, and the amount you have invested is not going to be enough if there's a 20 or 30% market correction. And then it really becomes finding a mix of investments that give you some capital stability, so you're going to probably have some fixed income or cash type investments, and also some growth. But you really do need to be asking that question: what happens if I get that short-term drawdown? The smaller volatility fluctuations, the day-to-day 0.25%, etc., that's just part of markets.
Yeah, and that feeds nicely into another question, which is, what do you actually call long-term? You've talked about market cycles, long-term, short-term, medium-term.
Look, as soon as I say something, I'll probably be proven wrong. But if you look at history, some people say it's a 17-year cycle or a 20-year cycle, it's or a 10-year cycle. So the big ones are long-term, and the problem is we haven't had a big correction since the GFC. So people are saying, when is it coming, or is it coming? And at some stage it probably will come. So we need to be sort of cognizant of that. And then the short term, I tend to think of, what do I need in the next 1 or 2 or 3 years, and then what goes out beyond that. But it's a really tough one to answer.
Yeah, and it's different for everyone.
Of course,
absolutely.
Yeah.
I mean, we're talking about people starting out and just first implementing into their super, and that being a long horizon. Obviously, that you're looking at 40, 50 years within that. So, even GFC type events that happen along there, traditionally or historically, have rebounded beyond that. So you can keep implementing on that front. So it really can vary.
And just a question perhaps for you, Alistair. ETFs have had a lot of volume over the past few years. Do you see this as a negative, as it may drive the markets higher and higher?
Absolutely. I mean, this is quite a common question when it comes to ETFs or any index tracking fund. One thing I think is really worth noting is the ETF landscape has evolved so much. It's no longer just your ASX 200 or index trackers or your S&P 500. I mean, today we've mentioned that loads of different sectors, international, different markets. As with anything, if every single person buys the same exposure at the same time and sells at the same time, it's going to push it higher and push it lower. If you actually look at the volume traded of ETFs, particularly in Australia, it's a very low number when you compare it to the volume of stocks traded. So I don't think at this stage it's a major concern, and it is one. I don't know if you have anything to add there.
Yeah, let me add to it. I don't think it's a major concern at all if what you're buying is a transparent index-based ETF, because at the back end, you buy the ETF. The ETF manager is actually buying and selling those stocks that underlie the ETF. So whilst you may see volumes in an ETF going up, the underlying shares are huge, and the market is huge, and the ETF issuers are acting in that massive market, and the creation redemption mechanisms make sure that the prices are in line. So I don't see that as an issue with good quality ETFs.
Yeah. Yeah, and look, just a final question. Do ETFs deal with franking, and we could even say dividends, in the same way as shares?
Yep, absolutely. So, I mean, all of the funds that we've mentioned actually are holding the physical stocks within the index. So all your Australian equity ETFs, franking and dividends that they receive are distributed to investors. One thing to be aware of is if funds grow significantly, then those between receiving the dividends and the franking credits to the fund distributing, they may have to distribute that among a larger number of unit holders. But yes, any franking credits received by the fund are passed on to unit holders.
Great, thank you very much. I'd just like to thank everyone for joining us, and just a reminder that you will receive a copy of the session and the slides in an email later today. We do thank you for joining us, and please give us your feedback. We really do appreciate you attending, and we look forward to joining the next one. Thanks so much. Thanks, guys.
Thank you.
Thank you.